हाँ सर, स्टार्ट करिए सर।
Okay. Hello, good evening everyone. I'm CA Gautam Lat, Vice Chairman of IDT Committee of WRC. I welcome everyone on behalf of WRC of ICI. So before starting the session, I request everyone to kindly place your hand on heart for ICI motto.
येष सुप्तेषु जाग्रति येष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्द्वैता 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 एतद्द्वैता.
Thank you, Mishra ji. So this is the second part of Sectorial series which we are having. WRC has launched a Sectorial series covering 15 different sectors, which we are doing in 3 parts. This is the second part which we are starting today. We also having a national conference on GST, which will be launched soon in August. So I request everyone to kindly enroll for the same also. Now quickly, before starting the session, I request CA Murtuza Karchwala, Chairman of WRC, to kindly give his opening remarks and address the participants. Sir.
Thank you, Gautam. A very warm good evening to all the participants. We have almost 150 registrations, and thank you very much for showing the interest in this sector-specific series. Let me first welcome CA Divyesh Lapsiwala. Divyesh, thank you very much for accepting our invitation and joining and deciding to share your knowledge with all the participants. Extremely grateful. Thank you. I also recognize presence of WRC Secretary Shweta Jain. Let me thank the Chairman of Indirect Tax Committee, Yashwant Kasar, and the aggressive and dynamic Vice Chairman of Indirect Tax Committee, Gautam Lat. He never sits silent. He keeps on doing something new. And I think really a lot of action happening on the Indirect Tax Committee and the GST side. While we were discussing, see, the important aspect now is every client looks at value addition, and knowing certain things generally is one aspect of it. But when you are specifically providing service to a particular industry client, if you know the nuances of those industries and what are the challenges and like how do you handle them, and for a particular section or a particular judgment, how do you apply to a particular industry specific, I think that industry specific knowledge is very, very important, and that is when we'll be able to add real value to the clients. And considering this, I think Gautam took the lead and he planned 3 sectorial series, part 1, part 2, part 3, and we're covering 15 industries. And in the first part, I think we covered the real estate, construction, infrastructure, and similarly, like multiple of them, from healthcare to pharma to hospitality. And today we have Divyesh here speaking to us on the indirect tax implication in banking, NBFC, so especially on the financial borrowing and lending side. And so similarly, we'll keep doing this 5-week, the 5 industry, and then we'll go to a 3rd series as well. So friends, thank you very much for joining. The 2 as you can see on the screen, the theme this year at WIRC is LEAP, leads towards excellence, achievement, and development. And we, to achieve this LEAP, we have listed down 5 goals. We have listed down various activities that we'll do, and we also listed the measurable criteria. And the important 2 aspects of it. One, of course, is updation on technical knowledge, which we are doing through these various series on direct tax, indirect tax, accounting standard, company law, and allied laws, and multiple other things. But we also felt that members in practice need to look at multiple new avenues of practice along with the traditional work which they are doing. And hence we have planned multiple refresher courses. We finished a refresher course on accounting standard, a refresher course on Ind AS. Currently, every Saturday, a direct tax refresher is going on. Next Friday onwards, internal audit refresher will start. And from 16th of this month, international tax refresher will start. So we'll do multiple refresher from cooperative to insolvency to valuation. And members can attend those 15 hours and then think through whether they want to really specialize and start practice in that area. Now, in addition to that, you will all agree with me that technology, adoption of technology in learning is very, very important. And we are doing multiple courses on technology, multiple. And whether it is 3 hours, whether it is 10, 12 hours, and whether it is a long duration. And we also launched 2-part on technology, which is 60 hours on data analytics. And we are teaching hands-on coding in Python and work on SQL database. It is Saturday evening, Sunday morning, and for a fee of 9,000 rupees. And the part 2 is like the visualization with Power BI and Tableau, 40 hours with a fee of only 6,000 rupees per member. So we would request you to keep joining us on various of the program, whether it is on technical subjects or on technology, and pick up whatever is of your interest. And in case you feel we need to do something different, please do write to us at wrc@ici.in. Happy to take all your inputs and plan those programs. I would once again thank Gautam and the Indirect Tax Committee for all the good work. Let me again thank Dicgc for joining us today. And thank you everyone for joining and registering for this course. Happy learning to all of you. And over to you again, Gautam. Thank you.
Thank you, sir. Thank you so much for your time and kind words. Now I request CA Shweta Jain to kindly introduce our today's faculty. Ma'am, over to you.
Thank you, Gautam. It's really a pleasure to introduce Divyesh Lapsiwala, who is more than 21 years of experience and partner with the indirect tax practice in EY and leads the Mumbai TMT and FS team. Also, he is advising clients on various indirect tax legislations. He has assisted clients across sectors, including financial services, media and entertainment, logistic, retail, infrastructure, manufacturing, and telecom, and others. So he has experience in handling large complex projects relating to restructuring, transformation, technology, implementation, and optimizations, and led several advocacy projects to work with industry and regulators to make tax policies more implementable. Also, his experience in handling tax controversy matters, including investigation and court disputes. So the Divyesh supports some of the key EY tax technology solution and works with clients to curtail their technology roadmaps. He is regular speaker at indirect tax conferences and has made several editorial contributions on the subject. So with this brief introduction, I welcome you at WIRC, Divyesh, and thank you for accepting our invitation. Thank you, and over to you.
Welcome, sir.
Thank you. Thank you so much. Thank you so much. Thank you for the invitation to speak on this topic. It's a topic very close to my heart. I do a lot of work in the sector, so hopefully I should be able to do some justice to the series and get some value to the participants who've joined in. This is a multifaceted industry. We are covering banking, NBFC, and stockbroking today. And there are several open issues that this sector deals with and has been dealing with over a period of time. I have a presentation deck that we will go through briefly. The key opening message that I would give for this sector is that I think understanding of the products and offerings is very important. They're very different from what we usually see in other service sectors where you have a primary service that is being rendered. So there is one supply, telecom company does telecom service, or a logistics company will provide logistics, or a healthcare company will provide healthcare. Banking, the way it has evolved, has transformed into multifaceted offerings. These are offerings for different segments of the society. These are offerings for different participants in the whole value chain, from the largest corporates to the smallest businesses, to individuals, to nationals and people who are outside the country. It is also an integrated service because it integrates with the global money flow. It is a critical element in the whole trade flow that happens between countries. And at the same time, it is the most digitally disrupted business. And therefore, the number of questions and challenges keep evolving very rapidly. The business models keep changing very rapidly. We never knew about UPI 3 years ago, and today we use UPI as if that is the only way of making payment, right? So the way this industry has changed and will keep changing is quite interesting. It brings a lot of technical challenges. But at the base, I would suggest that knowing the industry and its products is very important. There are certain nuanced differences which swing anything from interest to fees, anything from taxable to exempt, to taxable to export, to being an transaction which is that of a supply, to be a transaction in money, or transaction in securities or derivatives, and so on and so forth. So there are this is one unique industry where their output is both taxable and exempt, and in the same transaction you will have both taxable and exempt flows, right? So it's important that we understand why is it taxable and why is it exempt. The definition of supply will get tested to the core in this sector. Every time a new product comes in, you have to really sit and evaluate whether there is a supply of service or not, or is it just an incentive, is it just a subsidy, and so on and so forth. So it's a good challenging sector. It always brings a lot of learning, and I hope we are able to cover some of those today. The way I have structured the slide deck is to primarily focus on some of the topical issues that the sector is facing today. It doesn't mean that other issues do not exist. There are quite a few issues that this sector deals with, but we will focus on some of the key issues over the next hour and 15 minutes. And towards the end, I will try and leave 15 minutes so that we can have some time for questions. So I have divided the presentation in 3 parts. The first is banking and NBFC, which are very similar to each other. Second, we are talking about stockbroking. And third, there are common issues across financial services. It will apply both to banking as well as stockbroking. Now, I want to begin with the point that I just mentioned of taxable and exempt supply in the same flow. Interest. What is interest is at one level a very simple answer, and at another level a very nebulous question. And we need to really spend time to understand really what is interest. There is a definition of interest in the law. and it says means interest payable. So interest is defined as interest payable, which is interesting. So interest is interest payable in any manner in respect of monies borrowed or debt incurred, including deposit claim or other similar rights or obligation, but does not include any service fee or other charges in respect of monies borrowed, debt incurred, or in respect of any credit facility which has not been utilized. So if there is a fee charged, it is not interest. Now let's juxtapose this with the Income Tax Act. It again says means interest payable in any manner in respect of monies borrowed, debt incurred, same way, and includes. So if you see GST definition says but does not include. So income tax definition it says and includes any service fee or other charges in respect of monies borrowed. So income tax defines interest to include fees. GST defines interest to exclude fees. Clearly, the idea in GST is that service fee is a consideration, is a supply which is liable to tax, and the consideration for that is liable to tax. And therefore, there is a need to split interest and fees in a transaction. The concept to be understood is that when a financial institution gets into lending, the financial institution typically looks at IRR, or the internal rate of return, on a particular arrangement. The IRR is a combination of the upfront fees that you're making and the interest that you are going to make over a period of time. It is the IRR that decides whether the transaction will get closed or not on both sides. Now, the same IRR can come in with zero fees and a particular level of interest versus upfront fees but slightly lower level of interest. So let's take a very simple example and forget about complex IRR calculations, but I could have a situation where I give a loan and I am asking interest to be paid 34 over 3 years, so that my total earnings is 100. Or I could say, please pay upfront fee of 10 and then pay 30 over 3 years as interest. I'm ignoring the discounted cash flow because IRR always also factors in inflation and discounted cash flow, but assume there is a straight line there. What has happened in arrangement 1 is that everything is interest, but in arrangement 2, 10 is fees, which is liable to tax, and 30 is interest, which is not liable to tax. There is nothing which is right or wrong in this. It is the commercial arrangement. And if the commercial arrangement is that everything is interest and there is no upfront fee, then GST does not apply. But if the commercial arrangement is that there is also a fee involved, then GST will apply on the fee portion. So it's interesting. And this has been the case since this was brought to tax in 2001. So we've had 21 years of history on this. So this is nothing new. Banks and financial institutions are well aware of this, and therefore commercially what is the most workable in a particular transaction determines the GST outcome. Therefore, from one loan to the other, your GST outcomes may be different. Now, the Maharashtra money lending regulation I have quoted just to make sure that you understand that there are regulations that define interest and also regulate interest. So many a times you see situations where the amount that is payable as, let's say, penal interest or penal charge can actually exceed the principal. Now, one may call it as penal interest, or one may call it as amount in lieu of penal interest, and suggest that it's not liable to tax because it is interest. But is the effective rate of interest significantly exceeding what is allowed by regulation or not, is something that needs to be looked at. So every state will have their own money lending regulations. And you need to understand that regulation and see whether the regulation brings any restrictions on how much interest can be charged for the protection of the borrowers. And therefore, is it aligned with the way you are analyzing and determining classification of the amount that you charged as interest. Judicial principles have been very broad-based. Now, why do we need judicial principles? You will need judicial principles in situations which are slightly more complex. For example, it's very easy to say that I will charge 10% interest and therefore on 10,000 rupees, the annual interest is 1,000 rupees. A very straightforward answer, because 10% of 10,000 is 1,000. Therefore, if the loan was 20,000 rupees, the interest would have been 2,000 rupees. Consider a case where instead of writing 10%, I have said that in the agreement that an interest of rupees 1,000 will be leviable for this borrowing of 10,000. Okay. So we are not prescribing a percentage in the loan contract, but we are prescribing a fixed sum of money that is payable for the monies borrowed. Now, in those cases, a question will arise as to whether this is interest even if it is charged on a fixed basis, is regarded as interest. There are enough and more situations that you will see where the fixed amount charge does not appear to be in the nature of interest, but appears more in terms of fee, or appears more in terms of a penal levy for performance of contract. So I have a slide which covers those type of transactions. But the point that I want to make here is that interest does not have to be a percentage. The definition also does not require you to have it as percentage. Interest can be a fixed amount. It should but hold out to be in the nature of interest. So let's look at the point that I touched upon, which is a penal charge, not possibly interest, but a compensation. So let's look at foreclosure charge. You take a housing loan for 10 years and you go after 3 years and you want to close that loan. Now, as per the RBI guidelines, foreclosure charges are not leviable unless, I believe, you foreclose the loan within a very short period of time. But for a minute, let's assume that there is a foreclosure charge that applies on this home loan or this commercial borrowing. What is a foreclosure charge? The foreclosure charge is levied because the bank or NBFC knows that you're going to pay installments over the next 120 months in a 10-year loan at a particular periodicity. Based on that periodicity, there is a particular principal recovery as well as interest recovery that the bank has planned, which has determined its profitability and its long-term cash flows. Based on that, the bank may have gone and discounted those cash flows and sold the securities partially or as a true sale. Or the bank may have generated paper or taken positions in the money market or in the treasury bills market based on those projected cash flows. So once you come and disrupt that flow by saying that, okay, now after a month, after a year, after 3 years, I want to foreclose this loan, then question arises as to whether this foreclosure activity is liable to tax because the bank wants to levy a foreclosure charge. Technically, if you examine, the reason why this foreclosure charge is being levied is nothing to do with a supply or a service that is being provided by the bank to the borrower. The borrower is coming and terminating the contract early, and that early termination has been identified upfront in the contract. And the contract suggests that if you do an early termination, then this is the amount that is payable for getting the early termination facility. So a permission under the contract, which has been foreseen in advance, does that become a supply by the borrower to, does that become a supply by the bank to the borrower of quote unquote tolerating the termination of the contract? we have a very, very good judgment of the larger bench of the Chennai Tribunal in case of Repco Home Finance. It is a must read for everybody who is looking at financial services or is looking at contracts which have liquidated damages or damages clauses. This judgment beautifully brings out the fact that you need consideration for taxability, and consideration has to be for a supply. First question is there a supply? And second, is there a consideration? The foreclosure clause in the contract is a clause which is a condition to the contract. It is a clause which ensures specific performance of the contract. It is not a clause where the borrower is wanting a supply and the lender is wanting to make a supply. Where is the meeting of minds? The borrower is not holding out like in a manner to say that if you want a demand draft, I will charge you 25 rupees. So that is a offer for supply that has been made by the bank to the borrower. And the borrower may choose, or the account holder may choose to take that service, and he knows that it's going to cost him 25 rupees. So that is where a service provider is willing to supply, has determined the consideration, and is waiting for the acceptance from the other side, subject to all the conditions and regulations that apply. In this case, while the same 25 rupees may be specified as a foreclosure charge, that is to create a hurdle for the borrower not to exit the contract. The 25 rupees is not created to say, yes, I'm willing to provide foreclosure services. Please come and avail those services and I will charge you 25 rupees. So this point has been really well appreciated by the court. The court has said that a condition of a contract cannot be regarded as a consideration of that contract. It's a beautifully written paragraph. That every contract will have several conditions. For example, there is a condition that you are a person who is above 18 years of age and therefore you are willing to contract and you have the ability to contract. Now, if you are not 18 years of age and the contract is void, then the contract is void. Or if you are not insolvent, and if you are insolvent, the contract is voidable. Then yes, you are above 18, but the contract becomes voidable. The other party may cancel the contract. There may be a penalty because you did not specify or disclose, or you signed a condition of a contract which is incorrect. That does not mean that as a party who has suffered, I wanted to sign a voidable contract. I wanted to enter into a contract with an insolvent person so that I can earn the penalty for cancellation of the contract. It is too far-fetched. Okay. If I am constructing a bridge for, let's say, the government, and the government puts a clause to say that I will give you 1 crore rupees for building this bridge. You have to build this bridge in the next 2 years. But any delay beyond 2 years, for every day, I will reduce 1 lakh rupees. Let us say there is a 10-day delay, and therefore there is a 10 lakh rupee deduction. Is the government now providing a service to the contractor of receiving the service of delayed delivery of the bridge? And that is where the court has very beautifully articulated to say that penalty or penal consequence of breach of contract is not toleration of an act, is not a separate supply, and therefore is not taxable. This is very interesting because there's a 2006 circular which says foreclosure charges are nothing but services rendered by a bank or a financial institution to the borrower, and therefore they are liable to tax. This Repco home finance ruling not only therefore benefits financial services, but it will benefit all situations. Penal interest. Now, penal interest is another very interesting topic. Penal interest is interest that you charge if you do not meet a certain installment, and therefore a penal interest can get charged. Now, let us take a simple example. If, let's say, you have borrowed money at 10%, the contract may say that we will charge you penal interest of 2% if you do not pay an installment in time. So you paid the first 3 installments on time, you got charged 10%. Then on the 4th installment, you defaulted. Then you will be charged 10 plus 2 and interest will be debited to you. On the 5th installment, you regularized your 4th as well as your 5th. In that case, from the 5th installment, you'll again start getting charged 10%. So the question is that this additional 2% that got charged as in the 4th month, is that a consideration for a supply which is liable to GST, or is the supply in the nature of interest and therefore not liable to GST? This has been a matter of debate and litigation in the service tax era. In the GST era, we worked with the NBFC Association, and a circular has been issued on this, which is fairly clearly articulated. This is issued in December 2018. The circular clearly brings out the fact that in cases like these, the NBFC or the bank is not really providing a separate service to the extent of the additional 2%. This is a normal trade practice where you're recalibrating the interest because there is a default. If you look at it differently, the NBFC had made an assessment of you as a borrower to say, okay, he's a good borrower. He will pay his installments on time, and therefore 10% is a good rate. But then you default, and then from a good borrower, you become a slightly less rated borrower. If I had known as a bank on day one that you are a slightly less rated borrower, I may have possibly proposed 11% to you or 12% to you. I may not have proposed 10% to you. So this is a risk assessment of the borrower, and the risk on the loan goes up when there is a default. Second is that all the discussions that we did on foreclosure charges equally apply to penal interest. And appreciating both these points, CBIC has been kind enough to clarify that penal interest is not liable to tax. It is covered by the exemption notification, which was issued in the context of interest. So to conclude the conversation on interest, it's important that we understand interest and the definition of interest. We understand all the types of interest. And there are certain charges like foreclosure charges and penal interest, which are very closely connected with the topic of what is interest. And we need to be able to understand and appreciate some of these rulings and circulars to evaluate what is the consequence. Now we can touch upon 2 more interesting aspects in relation to interest, which are variable return on lending and co-lending. I did mention one simplistic example to say that what if I charge 1,000 rupees instead of 10%? Will it remain interest or not? There are other models like success-based interests, which is that the interest will change depending on certain contingencies specified in the contract. So if in the normal course, your interest is 1,000 rupees or 10%, the interest may become 12% if, let's say, another set of events happen, not a default, but a variable linked to certain performance related outcomes or certain contingencies. In that case, again, question arises whether the top up continues to remain interest or not. This is a question of fact. It is not possible to create a framework simplistically around these kind of arrangements to say all of these are interest. But if you have a variable interest lending structure, then we have to be very careful to understand the contractual relationship, how the agreements are written, what is the regulatory framework in which this is operating, does it continue to be time value of money, does it not, hopefully does not surrogate fees as interest, and so on and so forth. So it has to be carefully done, but these structures exist and these are also in the nature of interest. The last point is co-lending charges. Co-lending is where 2 or more people come together to finance a particular transaction. Now, there are very interesting models in co-lending. it could be a simpliciter model to say that there is a 10,000 rupee loan with 10% interest. Both have contributed, one has contributed 4,000, one has contributed 6,000. And therefore the 1,000 rupees gets split 400 and 600. So that is a very simpliciter arrangement. In these cases, both the NBFCs or banks will treat 400 and 600 respectively as interest, and there is no tax. But what if we say that while the capital contribution is 4,000 and 6,000, the interest of 1,000 is being shared 50-50. So the person who lent 4,000 gets 500, the person who lent 6,000 gets 500. In this case, if you go to the first concept, the IRR of the first person lending 4,000 rupees is much higher than the IRR of person lending 6,000 rupees. So in the same loan, there are two lenders who are getting a different rate of return. If that be the case, is it that the base IRR, which is established by the person lending 6,000 rupees, is interest, and everything that the first lender who's lent 4,000 rupees is getting above the base IRR, which could be about 120, 130 rupees, that is not interest. And if it is not interest, then what is it? Is that the way to look at it? Or can we say that both are interest because both are arising out of the same 1,000 that has been charged in the contract? Or does the contract have to be very specific? Or is the differential 130, let's say, IRR value that is being awarded to the first borrower, is it for some services that that borrower is doing in that transaction? And then what is the regulatory framework? So you will find in this fintech world some of these models of co-lending, and they're very, very interesting. Some of the front-end companies may not have enough balance sheet size to do large lending, but they want a larger share of the IRR, and that results in some complex structures which need to be really understood with a tooth comb to make sure that we are not rushing to call everything as interest, and we are not being overly conservative to say that anything above the baseline is not interest. The second topic I want to talk about, what I mentioned in the introduction, is about trade payables. So to understand trade payables or trade flows, what would happen in a simpliciter transaction is that if there is a export of goods from India to London, so there is a consignment going from Mumbai to London. In that consignment, the value of the consignment is 10,000 rupees. So the exporter raises an invoice of 10,000 rupees on the importer in London. The importer and exporter agree that for doing this payment, banks are required because that is a mandate under law. So there will be a bank of the exporter, let's say State Bank of India, and there will be a bank of the importer in London. So let's say Royal Bank of Scotland. So Royal Bank of Scotland is the bank of the importer outside India, and State Bank of India is the bank of the exporter in India. Now, the way money will flow is that the London importer will pay Royal Bank of Scotland. Royal Bank of Scotland will have to figure a way to get the money into the SBI account of the exporter. If you imagine a matrix structure, another importer in London may have his account in HSBC, a third may have in Citibank, a fourth may have in some local cooperative bank. So State Bank of India, who has to now receive the monies of this exporter, will then have to have a relationship with several banks, in fact all banks globally, because some or the other customer may have transaction on the other side in the same manner. If you flip the transaction and say that now there is a US exporter and a, let's say, Delhi importer, then again there will be banks of each of these people, and the Delhi importer will have to remit money from his SBI account to the US exporter's bank. Again, the US exporter may be working with n number of banks if you take all exporters together. And the Indian importer may also be working with all possible Indian banks if you take all importers of the country. So this is a very complex structure that arises where it is impossible for every bank to have a contract or a network with every other bank in the world. And therefore emerges the concept of correspondent banks. So State Bank of India will appoint a correspondent bank in London and say that all my transactions with all banks on the other side will be through, let's say, HSBC. So HSBC becomes the correspondent bank of State Bank of India. HSBC then aggregates all the collectibles of State Bank of India locally in the UK or possibly even in Europe, and then remits the money to State Bank. So in my first example, RBS will then make a payment to HSBC, HSBC will make a payment to SBI, and SBI will confirm to the exporter, I have received your money. Or in my second example, the Delhi merchant will use his SBI account to, let's say, make a payment to Citibank US. Citibank US, who acts as the correspondent bank for SBI in the US, will then make a payment to the bank of the exporter in US, which may be JP Morgan, and so on and so forth. Now, to enable all these structures, there is a guideline called UCP 600 and URC 522. This is a global guideline of relationship and behavior and trade flows between banks. It's more like a global best practice to say, okay, if you're involved in a trade flow, if you're a bank and involved in a trade flow, this is the SOP that you need to follow so that every bank gets the same set of documents that he would want to look at and cannot ask for anything more. Otherwise, as you know, different countries and different individuals in different locations can ask for a different set of documentation. I mean, if you go for a home loan, you yourself will find that different banks have different requirements of documentation. But that is okay, it's a one-to-one transaction. When there is a many-to-many transaction like this, it is impossible if every bank comes up with its own set of additional document requirements or format requirements. Which is why this UCP URC guidelines have been put in place to say that in a trade flow, this is the documentation that has to be generated and this is the only thing that will be available. So now, once you've taken care of understanding these flows and you've also taken care of the fact that these guidelines exist to enable the flows, you have to now appreciate that in my first example, Royal Bank of Scotland will have bank charges, State Bank of India will have bank charges, and HSBC will have bank charges. All three banks are not working for free, they will all levy charges. State Bank of India will debit the exporter, charge GST to the exporter will take a credit, matter is over. It's the simplest of all the transactions. HSBC will charge State Bank of India because HSBC is providing a service of correspondent bank to State Bank of India. State Bank of India will pay reverse charge, take 50% credit, and matter is over. Okay. The interesting aspect is foreign bank charge, which is the title of this slide. Royal Bank of Scotland also wants to recover some charges for doing this. Now, it depends on commercial contracting, who bears this Royal Bank of Scotland charge. Let's say if it is 500 rupees, 5 pounds or 500 rupees. Will the importer in London bear 500 rupees or will the exporter in India bear 500 rupees? Is a commercial negotiation between the two. If the exporter in India has to bear the 500 rupees, then London importer will pay 10,000 rupees to RBS. RBS will remit 9,500 to SBI. SBI will through HSBC, and SBI will credit 9,500 to the account of the exporter. But if this number or this 500 rupee has to be borne by the importer in London, then importer will pay 10,500 to the foreign bank. The foreign bank will pay HSBC 10,000 because he has to deduct his own 500. That 10,000 will come to SBI and SBI will credit the account of the exporter. So if you can understand, and then they can be sharing 50-50. So 250 can also happen. So if you understand, there are certain situations in which the collection of the exporter is lower to the extent of foreign bank charges. A question arose as to who has to pay reverse charge on these foreign bank charges? Because this is clearly a service. If that bank was in India, then service tax would have applied or GST would have applied. So for this 250 or 500 in my example, which is getting debited from the 10,000 rupees, who is the recipient of the service who is liable to tax? The Mumbai Commissionerate examined this this is way back in 2007-8, where they reviewed this arrangement in a lot of detail, and they developed a view that the Indian bank, which is State Bank of India in my example, is the recipient of the service of the foreign bank, and they use the UCP URC guidelines as contracts. And they concluded in a trade notice that these are contracts between banks, and that is the only way trade payables happen. So because there is a contract, RBS is rendering services to SBI, and therefore SBI should pay reverse charge in my example. Contrary to that, the banking industry had a view that this is all a payment and collection settlement mechanism. SBI is not even debiting this 500 rupees as an expense in its books of accounts. The charges are all debited to the exporter. The exporter regards this as an expense, and therefore the exporter should pay reverse charge. Now, interestingly, at that time, there were certain cases in Mumbai Sestat and other Sestats where exporters were charged for paying reverse charge. And the Sestat rulings came out to say, on the ground, and it's a very brief ruling, not argued in detail, but on the ground that the exporter does not even know RBS or HSBC in my example. He may not even realize till the end, till the money comes in, that it was RBS who was the bank of the importer. If he does not even know who the other side is, how can he receive a service from the other side? So it was on that ground that it was held that no, therefore exporters are not liable. And the revenue may examine whether the bank is liable. Now with that comment, revenue went after banks. And this litigation has been going on for a decade. There is now finally a favorable ruling of the Delhi tribunal in the case of State Bank of Bikaner and Jaipur. This was about a year and a half ago. It's a very, very well worded ruling. I would definitely recommend you should read this ruling. This ruling summarizes everything that we just discussed, from the smallest detail of how the transactions happen to the reasoning why SBBJ or a bank is not liable to reverse charge, because he's not the recipient of the service. The correct recipient of the service is exporter or importer. And therefore, the exporter or the importer is liable to pay reverse charge, who has agreed to bear the charges of the foreign bank. Whether he definitely knows the foreign bank or has a specific contract with the foreign bank or not does not matter. In fact, in the contract, he's agreed that even if I don't know the other side, I'm willing to bear the cost. So the minute you agree to bear the cost, you know that there is a service being provided by somebody. And that is a bank, and there is a service charge. Once it is a bank, place of supply can be established, and place of supply is India. And therefore, the exporter is the right person to pay the tax and not the bank. So it's a very good ruling. You must read. It gives you a very good understanding of some of these products. The next aspect I want to touch is Dicgc. Dicgc is has always been in news of late because of the few banks that went belly up, and cooperative banks, and then the RBI had to step in, and then there is a slow churn of all the monies that have been stuck in those banks to return into investors. Dicgc is a premium that you pay as a bank for getting an insurance that for every account up to 1 lakh rupees earlier and 5 lakh rupees now, the government will protect that money even if the bank goes belly up. So if you have monies up to 5 lakh rupees, the government will use the Dicgc premium pool to repay the account holders. So this is a premium that you need to pay to buy a mandatory insurance policy as a bank. to protect the interest of your account holders up to 5 lakh rupees. Of course, if you have anything more than 5 lakh, then it's not covered by the policy and it becomes an unsecured outstanding. So question arose as to whether banks are allowed to take input tax credit of Dicgc premium. Again, very interesting that revenue picked up this issue. We always thought it was a non-issue, but the credit was distributed on the ground that there is no nexus of this insurance service with the taxable service provided. So they looked at a bank as two separate establishments. One establishment that receives deposits and pays interest on savings bank accounts and incurs Dicgc premium for receiving the money and paying the interest. And a second part which does lending activity, generates fee income and pays tax on the fee income, claims interest as exempt. So they've said that the bank does two different activities. So in the first activity, which is savings bank account activity, there is no generation of a taxable supply, albeit there will be some supply in terms of some bank charges, checkbook charges, check bounce charges, or demand draft charges. But none of those charges are connected with protecting the money of the bank account holder. And therefore, Dicgc is a premium attached to only protecting the money of the bank account holder, for which there is no charge. And therefore, this is wholly used for an exempt supply, and therefore no credit. Okay. To our mind, this was completely far-fetched and complete dehorse understanding of a bank. The bank, by definition, is a person who lends money by accepting deposits. Okay. So unless there are deposits, I can't lend, right? And that is, I am in the business of money, of receiving money, investing money, lending money, collecting money, and so on and so forth. And this is a necessary insurance for me to receive money. If I don't receive money, how am I going to lend? So to hair split the bank into two different activities, the traditional banking activity into two different activities is definitely far-fetched. But all banks received massive show cause notices on this issue. Thankfully, we now have a favorable ruling of the tribunal larger bench in the case of South India Bank. And this ruling clearly brings out the fact that Dicgc premium is very closely connected with the entire operation of the bank. And therefore, there is no question of hair splitting banking into two different lobs and saying that one was related to only exempt activity and therefore not liable to tax, and the lending activity has no connection with Dicgc, which does not resonate with the way the bank operates. Now, moving on to the lending portfolio. So we looked at savings account and we looked at Dicgc. Another big issue in the savings world is the minimum average balance charge related litigation. It is a very complex and massive litigation that the sector is going through. There are writ petitions that have been filed, but I'm not spending time on that because it is a very long topic. If anybody is interested, you must read. There is enough coverage of this in the press on what is the litigation around. In my personal opinion, the show cause notices that have been issued on this topic are incorrect completely. And while the amounts are disproportionately large, to my mind, it is definitely going to fail, and banks should not have any risk on the topic. It is a very stretched interpretation of the law, and therefore I have really not put it out as a part of this deck. On the lending side, while we covered the controversy around interest, there is also a complexity around what happens to repossessed assets, primarily cars. You do a car loan, you repossess that car, and then you want to dispose that car. So how should it be taxed? Now, there are two provisions in the law. There is one provision which is under Rule 35, and there is another provision which is under notification 8 of 2018. These two provisions provide a margin scheme. The margin scheme under the rules says that if you are somebody who is in the financing activity and you're repossessing vehicles and then you're disposing those repossessed vehicles, then you get a SLM depreciation on the cars, and based on the SLM rates that are prescribed, you will be able to revalue the car WDV, and after arriving at the WDV, if you're selling at a rate higher than the WDV, so it's a 20% SLM, 5% per quarter. If you're selling at higher than that WDV, then you should pay on the difference, the rate applicable to that car. So in a simpliciter scenario, if I have a 5 lakh worth car and after 3 years I'm repossessing that car, then the depreciated value of that car after 3 years at 60% depreciation will be 2 lakh rupees. So if I'm selling that car at anything about 2 lakh rupees, I need to pay GST on the difference. If I'm selling that car below 2 lakh rupees, I don't need to pay any GST. If I've sold it, let's say at 2,50,000 rupees, then on 50,000 rupees, I need to find out the rate applicable to that car, which is, let's say, 48% if it is a gas guzzler top-end car. Starting from 29%, it ranges to 48 or sometimes 52%. So depending on which car you're looking at, the rate will apply. And that is the tax you need to pay. In the alternate, in January 2018, there was a notification 8 of 2018, which talked about sale of old cars. And it says that the sale of old cars will have the same margin computation that we spoke about, slightly differently though. And on the margin that you arrive, you have to pay a maximum tax of 18%. So there's 12% and 18%. So the upside of 8 of 2018 is that your rate of tax comes down from possibly 48% to 18%. And that is a massive difference. Why is that relevant? It is relevant because when you sell a repossessed car as a bank or a financial institution, whatever you receive is inclusive of tax. So if you receive 2,50,000 in my example, that is inclusive of tax. So if the tax rate is 48%, then a disproportionate component of that 2,50,000 that you receive, possibly let's say for rounding of 1,20,000, goes in taxes, and 1,30,000 comes back to you to offset the default of the loan. Okay. Whereas if the rate is 18%, then out of 2,50,000, only 50,000 rupees approximately will go towards GST. And therefore, what comes back to you is 2 lakh rupees to offset the loan. So there is a massive difference in the two rates, which causes a significant P&L impact for the bank. So definitely there is merit in looking at 8 of 2018 very closely. Now there is a difference, like I mentioned, in the way the margin is calculated. Margin is calculated not with SLM depreciation here. Margin is calculated based on the depreciated value under income tax provisions. So you have to basically consider this as the only asset in the block and depreciate it as per the income tax rules if a depreciation has been claimed under income tax. So if the buyer or if the seller has claimed depreciation under the Income Tax Act, then you find the depreciated value so that you don't take a double dip. You have already taken a deduction of part of it under income tax law. You cannot now take a double dip in GST. So find out the depreciated value of that asset, compare it to the sale price, and pay tax of 18% on the difference. If you have not claimed income tax depreciation, then you have to compare the sale price with the purchase price. And unless you're dealing with some very, very rare cars, your sale price will always be below purchase price because the repossessed asset used for a few years, default on the loan, clearly you will not receive more than the purchase price. And therefore, if the sale price is less than the original purchase price, your value becomes zero, and therefore there is no tax. So this is not only a situation where you will pay 50,000 rupees of tax versus 1,20,000 rupees of tax. This could be a situation where you pay zero tax versus 1,20,000 rupees of tax. Okay, so the saving just went up. Now there are issues in relation to this applicability of this notification. The first issue, it talks about purchase price. Now, as a financier, you've not purchased that car. The car was purchased by somebody else, and you're only disposing that car. So, can you say that this was the purchase price and this is my purchase price? So that becomes a controversy. The second aspect is that when it says that if you claim depreciation, find out the depreciated value. Now, you could not have claimed depreciation. Depreciation would have been claimed by the borrower. So, can you say that this notification is meant for you? There have been representations filed with the ministry for a clarification on this, so that there is parity. Because if the borrower had sold the car himself to foreclose the loan, he would have got the benefit. I'm only stepping into his shoes, and therefore I should get the equal benefit. In the end, I would mention that there is a much larger argument to say whether a bank or NBFC is at all liable to pay tax on disposal of repossessed assets. To my mind, there is a room to argue that there is no liability, because there is nothing in the act that deems the liability. There is only something in the rules 32(5) proviso, and there is something in notification which does not cover repossessed assets. So leaving that technical debate aside to say whether I'm really covered or not, the actual debate of whether Rule 32(5) proviso versus 8 of 2018, which will apply to me, and can I take the benefit of 8 of 2018, which brings much lower tax, is a technical one. Like I mentioned, this issue is under consideration. We are hoping some clarifications will come through. But when you take benefit or take positions under this, tread with caution, because it is controversial. If I add one more layer to it, the additional layer could be if you have a sale of car to your employees. Now, why is this an additional layer? The only additional layer is because he is a related person under law. And you may have the sale of cars to employees if you are a part of the car scheme, that at the end of a particular period, the employee will buy the car from you. In that case, again, while all the technical discussion we did on sale of old cars will apply, an additional angle that will apply is that because he is a related person, is the price that you're agreeing to sell it to him at a fair price. So, for example, if the employee uses the car for 5 years, and then you say that we take 20% SLM for our internal purposes. So at the end of the 5th year, you want to give him the car free because the value has become 0. If we challenge that situation and say that, okay, what if you would have sold this car in the open market, would you have got 0? And the answer would be no, because the car is in running condition, and that's why the employee is willing to take it. So in that case, you have to determine some sort of a fair value, because you are dealing with a related person. So you have to determine that fair value and then go to the same controversy of which notification applies and whether you are benefited or not. To my mind, you can take the benefit in this case of 8 of 2018. And by using that, you may have no tax outcome on this particular transaction. In repossessed cars, when you have refinancing, complications increase. So somebody had financed the car for the first 5 years and you are refinancing from the 6th year to the 10th year. So again, if you have a refinance structure, there are slightly more nuanced complexity of following 8 of 2018. So I would request you to just pay sharp attention to any such transactions that you see. So now that we have covered some of the asset and liability side of the bank, I want to cover some interesting transactions that take place in the banking and NBFC world, which are which are structured products or structured transactions which result in unique tax questions. So the first transaction we are looking at is securitization. What is securitization? Securitization is a transaction where I have a definitive cash flow. We talked about home loan as an example. So I have 120 months of definitive cash flow in my example. But I want all the money upfront. So I can go to another bank, NBFC, and say that here is the time value of money, discounted cash flow value of these 120 installments. I have lent it to Mr. X, whose credit rating in CIBIL is more than 700, and therefore he will definitely pay on time. So here is the asset value. I would believe that if the total cash flow of this over a period of 10 years is 5 crore rupees, if you give me 3 crores today, I'm willing to transfer this loan to you. The other side may agree, and therefore the other side, the first bank will get 3 crores cash immediately, and the other side will then keep receiving the installments as we go along. There will be an escrow account which is set up so that once the borrower pays the first bank, automatically the money goes to the second bank. Now, in this transaction, what is the characterization of 3 crores? Is 3 crores a transaction of supply of a service, and that the first bank has rendered a service to the second bank for which it is receiving 3 crores, or is 3 crores not a supply, not liable to tax? So the debate arose because in certain quarters there was a view taken by the tax office to say that this transaction should be covered in the realm of tax. In fact, once GST was introduced, if you remember that 65B 44 said definition of service excluded transactions in money. But if you look at the service definition under GST, it only excludes money. So it does not exclude transactions in money. So the debate that arose is that because a securitization transaction is not money, but a transaction in money, can it be exposed to tax? There have been a few notices that have been issued on this topic. Thankfully, in the 2018 FAQ that was issued by on financial services, which is the last bullet on your slide, it says securitized assets are in the nature of securities and hence not liable to GST. However, if some service charge or service fees or documentation or booking charges like fees are charged, the same would be consideration for provision of services and liable to tax. Now, I want to highlight that a securitized asset is not necessarily a situation where I have created a portfolio and issued some securities out of that portfolio, right? There can be simpliciter transactions of just selling a loan from one bank to another, or selling the cash flows of a loan from one bank to another. There are several structures that happen in this space, and we need to examine each of the structures to know what is the arrangement. Also, there are certain complications that arise in a few structures of securitization. For example, if you partly securitize the asset, so you partly suggest that 70% of the loan is given to somebody else and 30% remains with the first person, and there is, let's say, a check bounce event. So the charges will also get shared 30-70. Who is supposed to charge GST on 100? And is the second bank supposed to then charge the first bank because he's receiving 70 of fees? Complex questions. You have to look at all the facts to determine. There is no straight answer to this. You have to look at the true sale agreement or the transfer agreement to understand whether the second bank is receiving a transaction in money or is receiving fees for a service, because otherwise check bounce charges are being offered to tax as a normal lending service. Very interesting case in the case of ICICI Bank, which was delivered by Mumbai Sistat. It's a good read as a case, and I mean, again, if you're looking at a securitization transaction, you must go through this ruling. It explains the transactions very well. It also is on a very interesting point of law. The point was that, let's say that there was a charge of 1% of the securitized portfolio from the buyer, from the seller to the buyer. So if I securitize, I also charge a fee when I securitize, and 1% of the portfolio is charged as fees. So in addition to, in my example, 3 crores, I'm charging 1% of the portfolio and therefore 5 lakh rupees of the 5 crore portfolio. So I'm getting 3 crore 5 lakhs. Because 5 lakh rupees is fees, ICICI Bank was paying service tax on the 5 lakh rupees. Now, there were certain transactions that ICICI Bank entered into, where this fee of 5 lakh rupees was, let's say, theoretically reduced to 1,000 rupees. So, in the same structure, the fee was 1,000 rupees, and then there was a value or the IRR of the loan of 5 crore rupees to a particular price. The revenue was of the view that the price of the securitization has been inflated and the fee has been artificially reduced to avoid service tax. So they invoked Section 72 under the Finance Act 1994, read with Rule 3, and did a best judgment assessment on ICICI and created a demand to say that we will, based on our, so there's a complex calculation being done, but based on our estimates, the minimum fee that you should have charged in this transaction is so and so, and that's how we are assessing this demand on. The tribunal has given a very strong fundamental ruling on when best judgment assessment can apply and what are the principles of applying best judgment assessment, and can consideration be derived from other flows as a part of best judgment assessment. The tribunal has rejected the revenues approach entirely and has said that essentially, if this is a commercial contract and the contract clearly brings out that this is the consideration, unless there is evidence otherwise, a presumption to say that because in another contract you are charged 1% fee, you are compelled to charge the same 1% fee, or you can benchmark that contract to determine what really is the fee element in the second contract, is not covered in the realm of best judgment assessment, is not covered by the valuation rules, and therefore is completely fallacious as an approach, and therefore it cannot be held against ICICI Bank. So, if you remember, we started with the controversy of or the point of some loans would have 33, 33, 34, and some loans would have 10, 30, 30, 30. The case of ICICI Bank is going to be very useful in such cases. So please go through this ruling and understand the nuances of interpretation that have been applied. Similar provisions of best judgment assessment also exist in GST, so this will have a bearing on GST as well. The other structured product we can talk about is on interest subvention. Interest subvention, we are aware and we might have experienced that there is an offer that is made by an OEM, let's say a phone company, to say that if you buy my phone through a retailer, and if you pay it through a particular credit card, or you take a loan from a particular NBFC or a bank, then you will get a zero interest outcome. Now, the zero interest outcome comes in because there is a cashback that is provided. So you may get charged the standard interest, but the same amount of interest will be given to you as cashback. This treatment of this transaction with the card holder or with the borrower is a different subject altogether. The more interesting question is, what is the treatment of this payment which is received by the NBFC from the OEM? So the OEM now is receiving, let's say if it is a 1 lakh rupee phone, and 5,000 rupees is interest on that for a 6-month loan, then the NBFC is going to receive 1 lakh rupees from the borrower, and is going to receive 5,000 rupees from the OEM, the phone company, through the retail partner, which is the retail store from where you bought. Is this 5,000 rupee therefore in the nature of interest earned by the NBFC? Because the NBFC anyway was looking at earning 5,000 rupees from the borrower, but OEM came in and said that no, don't take 5,000 from him. I will pay you 5,000 rupees. So effectively, borrower gets it at zero interest. So does this 5,000 rupee become interest and therefore not liable to tax? Or does it become fees charged by NBFC for agreeing to give an effective zero interest to the borrower? It's a controversial question. There is, again, we cannot have a straight answer to this question. In the olden days of service tax and VAT, this was a very, very pertinent question, because the OEM or the retail store, if there was a service tax charged on this cashback by the NBFC, would not be able to take a credit. So at that time, there were fairly aggressive positions taken. Since introduction of GST, we are seeing a trend towards people preferring to charge tax because credit is available on the other side. So you're eliminating controversy. In fact, there is a Mercedes ruling of an AAR which also suggests the same thing. If you want to still examine and evaluate how can this 5,000 rupee in my example be treated as interest, then you should walk through the entire logical debate of trying to appreciate and understand whether there was really a loan arrangement at where the borrower is very clear he has to pay 5,000 rupees, whether the OEM is directly, indirectly a party to that loan account, whether it is a situation where OEM is only paying interest on behalf of the borrower, and therefore it continues to be a money or interest charged for monies lent by the NBFC to the borrower, and therefore it does not matter where the money comes from. So it is quite complex. So if you're dealing with subvention or cashback scenarios, and there are many of those today that we see in very different formats, especially after the fintech explosion and card circulation increase, you must very carefully understand the treatment of interest subventions and cashbacks, and only then take a view on what is the right thing to do. That brings me to cards, and I think this is this is the last piece we are covering on banking. So on the card side, the credit card interchange has been a subject matter of debate. Credit card interchange is basically what happens in a situation where you use a credit card is that you have an issuing bank. Let's say State Bank of India is the issuing bank. You have an acquiring bank. Let's say HDFC Bank is an acquiring bank. And then you have the card holder and the merchant and the card gateway. So let's say I have a SBI card. I go to a store, and let's say Air India. I go to the Air India website. I buy a ticket for Bombay Delhi, and I use my credit card. If Air India is integrated with HDFC at the back end, then HDFC is acquiring that transaction, is using the Visa network, let's say, or the RuPay network, and is recovering that money from SBI, who's my card issuer, to make a payment to Air India. Now, like the foreign bank charge situation, all these parties will all charge some fees to do the activities they do. And the way the fees is charged is that Air India will pay fees upfront to HDFC, and HDFC through Visa will pass on a share to the issuing bank, which is State Bank of India. Question arose of what should be the treatment of the interchange, as it is called, in the hands of State Bank of India. So will the issuing bank be liable to tax? This matter has gone up to Supreme Court in the case of Citibank, and we've got a differing ruling between the two justices, Justice Joseph and Justice Bhatt, on the topic of whether the issuing bank is liable to tax on the interchange or not. The core question before the Supreme Court was that is the issuing bank rendering a separate service as compared to the acquiring bank, or is it an integrated service? The argument of Citibank was it is an integrated service. It is not that the issuing bank is rendering some service by issuing a card and then that entitles him to earn money. It is not that the acquiring bank is just doing a contract with Air India and that entitles it to earn any money. It is only when the issuing bank, the Visa network or the RuPay network and the acquiring bank all come together in a connected fashion, one transaction can be done. And therefore, all of them are collectively rendering a service to the cardholder and the merchant, to the merchant, I'm sorry. All of them are collectively rendering services to the merchant. And there is no service from issuing bank to acquiring bank and acquiring bank to Air India, in my example. So the two judges have had a different view. The judges have said that, one judge has said that the issuing bank is independently liable to pay service tax because it is a supply being made by him as a separate supply as compared to the acquiring bank. Whereas Justice Bhatt has said that no, it is one single service, and as long as the acquiring bank has paid tax on the entire value that it collected from Air India, no further tax obligation should arise on the issuing bank. This matter is pending, and it continues to be pending before the Supreme Court. It will get referred to a larger bench and will be examined because there is a differing view. Since GST, we have seen that banks have transitioned from this position of issuing bank not paying tax to issuing bank actually charging tax to the acquiring bank, because now everything is fully creditable. So there is absolutely no need to really create a dispute around this. So that's one more product of credit card, which is quite interesting. I'll just move over to stockbroking. So on stockbroking, I think the big piece on stockbroking is about the whole interpretation of intermediary. And there is a Bombay High Court ruling, as we know, in the case of Dharmendra Jani, where they have tried to interpret what is intermediary and what is the scope of intermediary, and whether an intermediary service can be exported, or is it liable to tax based on the place of supply regulation specified under 13 subsection 8. Now there is, there are very divergent views expressed again here by two judges. One judge on the principles of destination-based consumption tax is saying that if the destination and consumption of intermediation service is outside, it is not taxable in India. The other judge suggesting that we have to go by the regulation and 13.8 is a valid law. And if the parliament has decided that intermediation is liable to tax, then it is liable to tax, does not matter where the consumption is. The consumption is deemed to be where the place of supply says it is deemed to be, and not a theoretical consumption of trying to find a destination based on the location of the buyer of service. So interesting perspective on intermediary. Why is this relevant? It's relevant because all broking activities fall under the intermediary category, and they are liable to tax where the broker is located. So if the broker is located in India, then you will always be liable to tax, irrespective of whether you're receiving consideration in INR or in convertible foreign exchange. You must track this ruling because this ruling will definitely impact the outcomes for stockbroking industry. It also, of course, goes ahead and impacts some other industries, for example, investment banking or marketing support services providers. And there is a active consultation being done with the CBIC also to try and see whether there is a law committee report on intermediation that can be accepted, and the rule can actually be changed to service recipient based rather than location of service provider based. And the last point will be a connected point on stockbroking, which is the interest and charges levied by stockbrokers. So if a stockbroker again has to receive payment from you on a T+2 basis, does not receive that money, and then levies a delayed payment charge on you, is this delayed payment charge or interest in the nature of interest or charges? And therefore, again, is it liable or not liable? A lot of discussion and controversy, a lot of litigation on this topic. Thankfully, in the December 2018 clarification that came in, that clarification says that a stockbroker who is charging interest for default on the principal amount due is not liable to GST on that amount. So this is, again, we work with the stockbroking industry on this issue. The only word of caution, two important points of caution I would highlight. The first is that unlike a bank or NBFC, which is by default under the 50% rule for its lending activities, stockbrokers do not have a 50% rule. And therefore, any amount of interest that you earn, which is not liable to tax, that will trigger a 42, 43 reversal. So there is a knock-on effect of taking the interest zero rating, interest exemption benefit. The second is that when you charge interest on the outstanding amount as a stockbroker, you will charge on the outstanding balance. If the outstanding balance includes brokerage and some of your charges, whereas it also includes the base principal or the amount that has not been paid. This FAQ and interest exemption will work only for the interest on the base amount. The interest that you charge on the broking commission or any other charges you've levied will be taxed because of this specific section that we have in section 15, which says that any interest charged on delayed payment of consideration will be liable as if it is the same consideration. So these 2 points really need to be kept in mind before taking a position. On the common front, I think we've kind of run out of time, but I would urge you to, when you look at this sector, you should look at the interplay. So this sector is one of those service sectors where you will have multiple tax registrations, and you will therefore have the question of applying the input tax distributor principle, which is section 20. So is ISD required by you? Is it mandatory? Is it optional? There's a draft circular which is placed before the GST Council, which says that ISD is mandatory, but there's an FAQ in the past in 2017 and 18 which says it is optional. We know that there are some advanced rulings which say it is mandatory. In fact, advanced rulings go down to the detail of what expenses should definitely be done only through ISD. So examining section 20 is very important because this sector is a multi-presence, multi-state presence sector. So do you need to be ISD? ISD is defined as an office which receives common services. So important to understand that ISD may not be only the head office. ISD will also be regional offices if you have such regional offices. So if Delhi is controlling the whole of North and Delhi is therefore possibly incurring, let's say, all the media ad spend for North or market strategy for North, then those third-party expenses are also to be deferred to those states because the invoices are common across states. So ISD is one topic. And in the same breath, you have cross-charge as another topic. So you should look at the need of how section 25 applies to you, and the fact that you're a distinct person and there is a specific requirement in Schedule 1 that supply between distinct persons, you need to have consideration and you need to pay tax on it. You have to evaluate how will you tax these transactions. First is what are the common expenses and costs that are being incurred. Second is that what are the services therefore or benefits that are flowing from one state to another. Are there reverse benefits flowing, which means so today is the day of any branch banking. So I can be in a different state and I can withdraw from their ATM, go to the branch. So is that state then rendering services to my home state? And therefore every branch, possibly every state is rendering service to another or receiving services from another. So for all these transactions, how are you going to capture those transactions? How are you going to value those transactions and pay tax on those transactions? What is the benefit that you can take of the provisions of section 16 and 17, which give you the flexibility of special rules for cross-charging, special rules for input tax credit, and how do you take advantage of Rule 28 proviso, which says that if tax is fully recoverable, then you don't need to worry about valuation. So these are very important aspects for this sector, which is spread across the country, and you definitely need to spend time to determine both ISD and cross-charge. This cross-charge is not just about common services. Cross-charge question will also arise about people, will also arise about regional offices and leaders. will also arise about head office related costs or overseas costs or brand costs that are coming to you, royalties that you're paying, license fees that you're paying globally. So what is it that is a supply from one office to another, and how can you value it, is a topic by itself. I think it will take another hour if we just talk about this topic. But you need to understand these flows, understand the implications on these flows of Section 25 and Schedule 1 Entry 4, Entry 2, and also Entry 4 if you're receiving services from outside related parties, and then map it out in your implications. So I think that's about it. I've slightly run over time, but we have, at least I've run past all the slides that we wanted to cover. Happy to take a few questions for the next 10-15 minutes. There are a few questions in the chat. So for the foreign bank transaction, I mentioned that it's an SBBJ ruling. Yeah, okay, somebody has responded. Thank you. Is it mandatory for sub-broker, is the person taking agency from Motilal to get registered in GST, the commission received is below 20 lakhs? No, it is not mandatory. If your emoluments or if your turnover is below 20 lakh limit, then it's not mandatory to take registration. Okay, I think we've covered the questions. If there are any other questions, please put them on the chat. Excess income spread on assignment transaction is liable to GST. So, like I mentioned, and the ICICI ruling is going to be very helpful for you. If your excess income spread is about valuation of the discounted cash flows, then it's a part of the valuation of the transaction in money and should not be liable. And to that extent, you should read the ICICI ruling. If, however, that is more as a fee that you are charging and determining, then it should be liable. But mostly it should be the way you've written your question. It should qualify for a transaction in money situation. Is lending a service? Okay, very, very big question. Is lending a service? And one can have a very extensive debate on this. I would humbly suggest that because service is defined as everything other than goods, it is better to accept that lending is a service. And any of those challenges that have happened to service tax era of charging tax on a particular supply, other than lawyers, nobody has succeeded. So I would leave that for somebody else to dispute, and I would love to read that case law, but I would not prefer to take that view. Okay, so I think thank you all for being here. Anybody from the WRC on the webcast?
Hello.
Yes.
Yes, sir. बोलिए ना.
So we have come to the end of the session.
Yes, sir. Yes.
So there's one more question of whether due to SBBJ ruling you should pay reverse charge on the bank charges. My view is yes. If you are an exporter or importer bearing foreign bank charges, you are the right person in my view to pay the reverse charge. So you should definitely offer that for reverse charge. So thank you all. I think the next speaker is unable to join, is what I was advised. So the WRC representative, should we close the session? Sorry, just hold on. Maybe I'll just give him a call to understand. Because I believe the next speaker is unable to join. I'm awaiting their revert.
सर 2 मिनट रुके ना.
Hello. Am I audible, Mishra ji?
Yes, sir. Yes, sir.
So there are no open questions. Any questions?
We've covered, Gautam.
Which we have covered. Okay. So thank you, sir. So I'm here to propose formal vote of thanks on behalf of WRC of ICI. It was a great session. Thank you so much for your valuable time and sharing your rich experience and knowledge with us. I'm sure all the participants will take a great learning home today, and they are more beneficial when they are working in banking and BFSI sector. They'll be more careful, and as you mentioned in the start that this is one industry where to knowing product or to know the complexity of revenue is more important to determine the aspect of GST or aspect of supply. So you have very well explained all the products, be it interest, be it on outward revenue side. So I'm sure all of us will be great benefited by your experience. Thank you so much. I would also like to thank all the participants for joining us today. We will meet next Thursday for the next session. Thank you so much, sir.
Thank you.